Tomorrow morning, millions of bank accounts across the country will receive Social Security deposits. Some of those deposits may reach or exceed $2,400. For many households, this payment is not optional income. It pays the electric bill. It covers groceries. It keeps prescriptions filled. It keeps housing stable. That is why understanding exactly how these payments work matters. Not in theory. In real life. If you're interested in this topic, hit the like button, subscribe, and type "interested" in the comments. And I will give you a heart. A surprising number of people assume Social Security deposits arrive the same way every month for everyone. That is not how the system operates. The payment calendar is structured. It is predictable. But only if you know where you fall on it. When people misunderstand their payment schedule or their benefit calculation, they can miss important details. Sometimes that leads to unnecessary late fees, overdrafts, or confusion. In some cases, it leads to people missing money they are legally entitled to receive. Let's walk through this clearly. The Social Security Administration uses a staggered payment calendar to distribute benefits to millions of Americans each month. This system has been in place for decades, originating from practical necessity rather than arbitrary bureaucratic decision-making. It exists because sending tens of millions of payments on a single day creates enormous strain on banks, financial institutions, and payment processing systems across the country. By spreading payments across multiple days throughout the month, the SSA ensures that the banking infrastructure can handle the volume without delays, errors, or system failures that could leave beneficiaries without access to their funds when they need them most. The 1997 dividing line. The current payment schedule creates an important distinction based on when you first began receiving Social Security benefits. If you began receiving Social Security before May of 1997, your payment usually arrives on the 3rd of each month. For these long-term beneficiaries, your birthday does not affect your payment date in any way. This group receives their deposits consistently on the same day each month, making financial planning straightforward and predictable. However, if you started receiving benefits after that cutoff date, your payment schedule depends on your birth date. This change was implemented specifically to manage the growing number of beneficiaries as the baby boomer generation began approaching retirement age. The SSA recognized that concentrating all payments on a single day would become increasingly problematic as enrollment numbers continued to climb year after year. How birth date determines payment day. For beneficiaries who enrolled after May 1997, the payment schedule follows a simple pattern tied to the day of the month on which you were born. Born between the 1st and the 10th, your payment arrives on the 2nd Wednesday of each month. This means if your birthday falls on any day from the 1st through the 10th, regardless of the month or year, you can expect your deposit on that 2nd Wednesday. Born between the 11th and the 20th, your payment arrives on the 3rd Wednesday of each month. Beneficiaries with mid-month birthdays fall into this category and should plan their finances accordingly. Born between the 21st and the 31st, your payment arrives on the 4th Wednesday of each month. Those born toward the end of any month will receive their benefits later in each payment cycle. Holiday adjustments and consistency. Holidays can shift payment dates slightly when they fall on or near your scheduled Wednesday. If a federal holiday coincides with your normal payment date, the SSA typically issues payments on the business day immediately preceding the holiday. Despite these occasional adjustments, the fundamental structure stays the same throughout the year, providing beneficiaries with a reliable framework for anticipating their income. Why this matters for your finances. Knowing your exact payment Wednesday allows you to schedule bills, rent payments, and other financial obligations with confidence instead of guessing when your money will arrive. You can set up automatic payments for utilities, insurance premiums, and other recurring expenses to process shortly after your scheduled deposit date. This knowledge eliminates the anxiety of wondering whether funds will be available when creditors expect payment, helping you avoid late fees, overdraft charges, and damage to your credit score. Understanding this system empowers you to take control of your monthly budget and build a more stable financial foundation. A $2,400 deposit does not automatically mean everyone received a raise or that the Social Security Administration has increased benefits across the board. When beneficiaries notice larger than expected amounts appearing in their bank accounts, they often wonder whether a policy change has occurred or whether they somehow qualified for additional money. In most cases, however, larger deposits usually reflect one or more individual factors specific to your personal benefit history rather than a universal increase affecting all recipients. Common reasons for higher payment amounts. Several factors can contribute to a Social Security deposit that exceeds what you might consider typical. Your regular monthly benefit represents the foundation of what you receive. This amount is calculated based on your lifetime earnings record, specifically your 35 highest earning years of work. Individuals who consistently earned at or above the maximum taxable earnings limit throughout their careers will naturally receive higher monthly benefits than those with lower lifetime earnings or shorter work histories. Cost of living adjustments occur annually when the SSA increases benefits to help recipients keep pace with inflation. These adjustments, commonly called COLAs, are tied to changes in the Consumer Price Index and can add meaningful amounts to monthly payments during periods of higher inflation. Recent years have seen some of the largest COLA increases in decades, which has pushed many beneficiaries into higher payment tiers. Back payments from corrections sometimes arrive when the SSA identifies errors in your benefit calculation or processes appeals you have filed. If the administration determines you were underpaid for any period, they will issue retroactive payments covering the difference, which may arrive as a lump sum or be added to a regular monthly deposit. Supplemental security income provides additional assistance to individuals with limited income and resources who are aged, blind, or disabled. If you qualify for both Social Security retirement benefits and SSI, these payments may sometimes be combined or arrive close together, creating the appearance of a single larger deposit. Survivor or spousal benefit adjustments can increase your monthly amount if you become eligible for benefits based on a spouse's or deceased spouse's earnings record. When these benefits exceed what you would receive on your own record, the SSA adjusts your payment accordingly. Retroactive recalculations happen when the SSA reviews your earnings record and discovers previously unreported income or corrects inaccuracies that affect your benefit amount. These recalculations can result in both ongoing increases and one-time payments covering past underpayments. Understanding typical benefit amounts. The average retired worker benefit sits in the mid-$1,700 range per month, though this figure represents only a statistical midpoint among millions of beneficiaries. Some receive more based on their earnings history and claiming decisions, while others receive less due to lower lifetime earnings, early claiming penalties, or shorter work histories. The maximum benefit available depends heavily on when you choose to begin receiving payments and whether you worked consistently at high income levels throughout your career. Maximizing your benefit through delayed claiming. People who worked at high earnings levels for decades and delayed claiming until age 70 may receive significantly higher amounts than the national average. For each year you postpone claiming beyond your full retirement age, your benefit increases by approximately 8% through delayed retirement credits. Someone who waits until 70 rather than claiming at 62 could receive a monthly benefit that is 77% higher than it would have been at the earliest claiming age. Combined with a strong earnings history, this strategy can produce monthly payments well above $4,000 for some individuals. When multiple payments combine, multiple payment sources can sometimes arrive together, creating a larger single deposit that might seem unusual or unexpected. This consolidation does not indicate an error or a special bonus but simply reflects the timing of various benefit components reaching your account simultaneously. Understanding the composition of your deposit helps you plan appropriately and recognize that future payments may return to a more typical amount once any one-time adjustments have been processed. Claude is AI and can make mistakes. Please double-check responses. Each year, Social Security benefits increase based on inflation through what the administration calls cost of living adjustments. These annual increases are designed to preserve the purchasing power of your benefits as prices rise throughout the economy. Without these adjustments, the fixed dollar amount you receive would gradually buy less and less over time, effectively reducing your standard of living even as your nominal payment stayed the same. The SSA calculates these adjustments using changes in the Consumer Price Index for urban wage earners and clerical workers, comparing prices from the third quarter of one year to the same period in the previous year. The power of compounding adjustments. These adjustments compound over time, meaning each year's increase builds upon the previous year's higher base amount rather than starting fresh from your original benefit. This compounding effect can significantly boost your monthly payment over the course of a long retirement. Someone who began receiving $1,500 per month a decade ago might now receive substantially more simply through accumulated annual adjustments, even without any changes to their underlying benefit calculation. Over 20 or 30 years of retirement, this compounding can add hundreds of dollars to your monthly income compared to what you initially received. When adjustments arrive late or require correction. Occasionally, adjustments are applied late or incorrectly and later corrected by the Social Security Administration. Administrative errors, processing delays, and system updates can all contribute to situations where beneficiaries do not receive their full entitled amount when they should. The SSA maintains records of what each person should receive, and when discrepancies are identified through internal audits or beneficiary inquiries, the administration works to rectify these mistakes. When that happens, back payments may be issued automatically without requiring you to file a claim or contact the SSA directly. The administration recognizes its obligation to pay beneficiaries correctly and will proactively send funds owed when errors come to light. These corrections might cover a single missed adjustment or potentially span multiple years if a systematic error affected your payments over an extended period. Unexpected deposits and beneficiary confusion. These deposits can arrive with little advance notice, sometimes appearing in your bank account before any explanatory letter reaches your mailbox. The disconnect between electronic payment delivery and postal mail means you might see extra funds in your account days or even weeks before receiving official documentation explaining the payment. Many people see the extra funds and are unsure why they appeared. This uncertainty is understandable given the complexity of Social Security calculations and the multiple factors that can influence your benefit amount at any given time. Some beneficiaries worry that the payment was sent in error and might need to be returned, while others wonder whether they should spend the money or set it aside until they understand its source. This confusion can create unnecessary stress during what should be a welcome financial surprise. The importance of documentation and record keeping. It is important to review notices and keep records so you understand exactly what the payment represents and can verify that you received the correct amount. The SSA sends notices explaining benefit changes, adjustments, and corrections, but these documents can be dense and difficult to interpret without context. Maintaining organized files of your Social Security correspondence allows you to track changes over time and identify any discrepancies that might require follow-up. Creating a simple system for storing these notices, whether in a physical folder or a digital format, helps you build a comprehensive picture of your benefit history. When you receive an unexpected deposit, you can reference your records to determine whether it aligns with a pending adjustment you were previously notified about or represents something new that warrants further investigation. This documentation also proves invaluable if you ever need to dispute a payment amount or request a recalculation of your benefits. You can access your personal Social Security statement and payment history through the SSA's online portal at ssa.gov, where you can create or log into your My Social Security account. This resource provides detailed information about your earnings record, benefit estimates, and payment history that complements the notices you receive by mail. Your benefit is calculated using your highest 35 years of earnings, making your lifetime work history the foundation of everything you receive from Social Security. The administration takes your annual earnings from each year you worked, adjusts them for wage inflation to reflect their value in today's dollars, and then selects the 35 years in which you earn the most. These top earning years are averaged together and run through a formula that produces your primary insurance amount, which serves as the basis for your monthly benefit. If you worked fewer than 35 years, the SSA includes zeros in the calculation for each missing year, which can substantially reduce your average and lower your monthly payment. This is why continuing to work, even part-time, can sometimes increase your benefit if those additional years of earnings replace zeros or low-earning years from earlier in your career. The impact of incorrectly reported wages. If wages were reported incorrectly in the past, your benefit may be understated without your knowledge. Every paycheck you received throughout your working life should have been reported to the Social Security Administration by your employer, with the corresponding payroll taxes submitted on your behalf. However, the system relies on accurate reporting by thousands of different employers over the course of decades, and mistakes inevitably occur. Errors can take many forms. An employer might have reported your earnings under a slightly misspelled name or an incorrect Social Security number. Payroll systems might have transmitted the wrong figures during a particular quarter. A company that went out of business might have failed to submit final wage reports before closing its doors. Self-employment income might not have been properly credited if tax returns contained errors or if Schedule SE was completed incorrectly. These mistakes might seem minor at the time, but they can have lasting consequences for your retirement security. Even a single year of significantly underreported earnings could cost you thousands of dollars over the course of a long retirement. How corrections lead to increased benefits. Corrections can result in recalculated benefits and retroactive payments when the Social Security Administration updates your earnings record to reflect accurate information. Once the SSA verifies that your record contains errors and receives documentation supporting the correct figures, they will recalculate your benefit amount using the revised earnings history. If this recalculation produces a higher monthly benefit, you become entitled to the difference between what you should have received and what you actually received. The administration will issue back payments covering this difference, potentially going back years depending on when the error began and when it was identified. These retroactive payments can sometimes amount to thousands of dollars, representing a meaningful financial windfall for beneficiaries who take the time to review and correct their records. Who faces the greatest risk of errors? This happens frequently for people with multiple employers, self-employment income, name changes, or older payroll records. Each of these situations introduces additional complexity that increases the likelihood of reporting mistakes. Workers who held numerous jobs throughout their careers, particularly those who worked in industries with high turnover or seasonal employment, have more opportunities for errors to occur simply because more employers were involved in reporting their wages. Each job transition created another point where information could be lost or incorrectly transmitted. Self-employed individuals face unique challenges because they bear responsibility for reporting their own earnings through their tax returns. Mistakes on Schedule SE, confusion about net versus gross self-employment income, or errors made by tax preparers can all result in underreported earnings that reduce future benefits. Name changes, whether through marriage, divorce, or legal proceedings, can cause earnings to be credited to records that become disconnected from your current Social Security number. If you changed your name and did not update your information with the SSA, earnings reported under your previous name might not appear on your current record. Older payroll records present particular challenges because documentation from decades past may no longer exist, and the systems used to report wages have changed significantly over time. Earnings from the 1970s, 1980s, or even 1990s may have been recorded using now obsolete processes that were more prone to error. Protecting your future income through periodic review. Checking your earnings history periodically protects your long-term income by allowing you to identify and correct errors while documentation may still be available. The SSA makes this process straightforward through their online portal at ssa.gov, where you can create a My Social Security account and review your complete earnings record year by year. Reviewing this record annually, or at least every few years, helps you catch discrepancies while they remain relatively easy to address. If you notice missing or incorrect earnings from recent years, you can gather pay stubs, W-2 forms, and tax returns to support a correction request. Waiting until you apply for benefits to discover errors makes resolution far more difficult, as locating decades-old documentation can prove nearly impossible. If you delay claiming benefits past full retirement age, your benefit increases by about 8% per year until age 70. This growth comes through delayed retirement credits, which the Social Security Administration adds to your primary insurance amount for each month you wait beyond your full retirement age. The credits accumulate automatically without requiring any special application or request on your part, rewarding patients with a permanently higher monthly payment. Full retirement age varies depending on when you were born. For those born in 1960 or later, full retirement age is 67. For earlier birth years, the age falls somewhere between 65 and 67 on a graduated scale. Understanding your specific full retirement age helps you calculate exactly how much you stand to gain by waiting. The mathematics of delayed claiming. The 8% annual increase breaks down to approximately 2/3 of 1% for each month you postpone claiming. While that monthly increment might seem modest in isolation, the cumulative effect becomes substantial over 3 years of waiting. Someone who delays from age 67 to age 70 adds roughly 24% to their monthly benefit permanently. Consider a worker whose primary insurance amount at full retirement age would be $2,000 per month. By waiting until 70, that same worker would receive approximately $2,480 per month instead. Over the course of a 20-year retirement, this difference amounts to more than $115,000 in additional income. For those who live into their late 80s or beyond, the advantage grows even larger. The increases stop accumulating at age 70, meaning there is no financial benefit to delaying past that point. Anyone who has not yet claimed by their 70th birthday should file promptly to begin receiving their maximum benefit without further delay. Lifetime income implications. This creates meaningful differences in monthly income for life, not just for a few years following your claiming decision. Unlike a one-time bonus or temporary adjustment, the higher benefit amount you lock in by waiting becomes your new baseline forever. Every future cost of living adjustment builds upon this larger foundation, amplifying the advantage of delayed claiming as the years pass. The decision also affects survivor benefits for married couples. When one spouse dies, the surviving spouse typically receives the higher of their own benefit or their deceased partner's benefit. A higher-earning spouse who delays claiming until 70 not only increases their own monthly income but also potentially provides a larger survivor benefit to protect their partner after they pass away. For married couples engaging in coordinated claiming strategies, the interaction between spousal benefits, survivor benefits, and delayed retirement credits creates numerous possibilities worth exploring. The optimal approach depends on factors including each spouse's earnings history, their respective ages, and their health circumstances. Why similar retirees receive different payments. Two retirees of the same age may receive very different payments simply based on when they claimed, even if their earnings histories were nearly identical throughout their working years. The claiming decision functions as a powerful lever that can push otherwise similar individuals into substantially different financial positions throughout retirement. Imagine two neighbors who both turned 70 in the same year and both had careers that would entitle them to a $2,000 monthly benefit at full retirement age. One claimed benefits immediately upon reaching 62, accepting the early claiming reduction that permanently lowered their payment. The other waited until 70, accumulating the maximum delayed retirement credits available. The early claimer would receive approximately $1,400 per month, reflecting the roughly 30% reduction imposed for claiming 5 years before full retirement age. The patient neighbor would receive approximately $2,480 per month, reflecting the 24% increase from 3 years of delayed retirement credits. Despite identical earnings histories and the same current age, one receives nearly $1,100 more per month than the other, a gap that will persist for the rest of their lives. Factors to consider in your claiming decision. While delayed claiming offers clear mathematical advantages for those who live long enough to benefit, the right choice depends on individual circumstances. Health status plays a significant role in the calculation, as those with serious medical conditions or family histories suggesting shorter lifespans may reasonably prefer earlier claiming. Financial need also matters, since delaying requires having other resources to cover living expenses during the waiting period. The break-even point, where total lifetime benefits from delayed claiming surpass what you would have received by claiming earlier, typically falls somewhere in the late 70s to early 80s depending on the specific ages being compared. Those who live beyond this point come out ahead by waiting, while those who die before reaching it would have received more by claiming sooner. SSI is separate from Social Security retirement or disability. It is needs-based and designed for individuals with limited income and resources. Some people qualify for both programs. Timing differences can cause payments to arrive together, increasing the deposit amount temporarily. Understanding which program each payment comes from prevents confusion. Widows and widowers may qualify for survivor benefits based on a spouse's earnings. In some situations, beneficiaries can switch between survivor benefits and their own retirement benefit depending on which pays more. Many people never realize this option exists. Periodic reviews can sometimes increase monthly income. Social Security benefits may be partially taxable depending on your combined income. For individuals, $25,000 to $34,000 may trigger partial taxation. Above $34,000 may trigger up to 85% taxable. For married couples, $32,000 to $44,000 may trigger partial taxation. Above $44,000 may trigger up to 85% taxable. This affects annual tax planning, not monthly deposits. Medicare Part B and Part D premiums are usually deducted from your Social Security payment. Higher income can trigger higher premiums based on tax returns from 2 years prior. If income has declined due to retirement or other qualifying events, adjustments may be available. This can change your net deposit. These rules affect individuals who receive pensions from work where Social Security taxes were not paid. WEP can reduce your own benefit. GPO can reduce spousal or survivor benefits. Each case is individual and often requires careful review. Your primary insurance amount is what you receive at full retirement age. Claiming early permanently reduces benefits. Delaying increases them. This decision affects lifetime income and should be made carefully. Before full retirement age, earnings limits apply. Some benefits may be withheld temporarily. Those withheld amounts are credited back later through higher future payments. After full retirement age, there is no earnings limit. Direct deposit is faster and safer. Paper checks can be delayed or lost. Electronic payment is strongly recommended whenever possible. If you believe your benefit is incorrect, you can appeal. Deadlines matter. Many appeals result in retroactive payments. Documentation is essential. COLA increases begin with January benefits but may appear in late December depending on the calendar. This is normal and not an error. Social Security is earned income deferred over decades. Understanding how your payments work protects your financial stability. Review your deposit. Confirm the amount. Follow up if something looks wrong. If this affects you or someone you care about, type check in the comments so others remember to review their deposits too. And if staying informed matters to you, subscribe so you don't miss updates that actually affect real life.